Breaking news about, I want to say, 45 seconds ago, we got the 5-minute warning. So we are expecting President Biden to come out there. And you can see way in the back behind that podium some all-electric vehicles. And of course, the president is expected to announce new ambitious emissions targets and a push to go all-electric, at least 50% of all cars going all electric by 2030. And I would just like to mention, too, as we're watching all of this, we do have most of the stocks in the space moving higher. So we'll keep an eye on all of the big auto names and, of course, the charging names. Charging stations is going to be a big part of it. All right. Speaking of charging, the biggest stock bull charging down Wall Street is now Goldman Sachs. The firm's strategists are lifting their year-end target for the S&P to 4,700, which implies a return of about 7% from here on out. Goldman citing strong earnings growth and low interest rates as the reason. Now, stocks can surpass record levels, but low interest rates, they may come up off the floor, as FOMC Vice Chair Richard Clarida just said yesterday. During a Peterson Institute event, the Fed may start to tighten the reins on the interest rate horses by the end of next year. So what's the trade now in anticipation of when that happens? Let's get right to our floor show traders. We're joined by Greg Branch of Veritas Financial and Phil Flynn. Greg, I'm thinking if we stay on this growth track, which is pretty hot, it could be sooner than the end of 22. Am I wrong there?
No, I don't disagree. I think, look, the claims number today showed that the Delta variant is not yet proving deleterious to the economy. We'll see if that maintains. But as you said, I think when we're looking at the S&P, I'm much more comfortable with growth in tech right now, given that we haven't really seen how the rising inflation, how the input costs, how the supply shortages are going to impact growth in that back quarter. And so I'm not comfortable right now being aggressive on the S&P until we know what that looks like, particularly when we calculate in that the Delta variant is affecting our trading partners, our sourcing partners, and they are much less progressed on the vaccination curve than we are, and their economies are closing down, all very inflationary.
We are within spitting distance of another S&P 500 record close. I just want to let our viewers know we need to be up about 20 points. We're up 16 at the moment. So let me just get to you, Phil. Give me your macro picture here. And the Fed funds futures are indicating that there's a 43% chance we will see a rate hike by the end of 2022.
I mean, that's good news, isn't it? I think doesn't it show that the economy's getting better, right? And I don't think that the inflation fear is all bad, right? Because, we haven't had pricing power. Admittedly, there's a lot of inflation issues that are being caused by dislocations in the market because of COVID. But ultimately, what we're seeing on the earnings side, things are looking pretty good. So Goldman is looking pretty good. So, why not, dance with the girl that brought you to the party and buy Goldman? Because, in an inflationary environment and a rising, interest rate environment, that stock should do very well. But I think it's kind of interesting. You mentioned the electric car stocks. Joe Biden, hey, the stocks are going up. We're going to go 50% electric. Why wouldn't they go up? We're paying for it. The taxpayers, right? All these companies are saying, yeah, we're all on board, Joe, as long as you get your checkbook out and start sending us money, right? And sure, we'll take your money to go 50% elected, but every one of those companies said they wouldn't do it unless the government supported them. So this is the taxpayer. So when you see those cars out there that they have at the White House, we paid for those. We're going to.
Greg, quickly, give me a sense, if you could, of, you mentioned big tech growth area. Is there a particular area, and what about the financials?
Right. So in terms of tech, what we saw this earnings season is that they completely decimated the narrative that the results, the strong quarters we've seen up to now, have been a result of COVID bump up or COVID pull through. There is a transition to cloud cycle going on. There is backlog in hardware. There's a software cycle. There's a digital advertising cycle. Those are all secular tailwinds we expect to continue and quite frankly, are somewhat immune to inflationary pressures and input costs. In terms of financials, of course, net interest margin and having a more favorable net interest margin environment is the tide that lifts all boats. But until we get to there, I would, as we've said, stay in those big conglomerates that have strong capital markets, strong issuance, strong M&A. That's been carrying them these last few quarters. So not only Goldman, but Morgan Stanley, Bank of America, JP Morgan. That's where I would wait for that net interest margin environment to improve.
Yeah, some of the best in class. Greg, great to have you. Welcome. Phil, as always, we appreciate it. We do just want to quickly let our viewers know that the crowds have begun gathering on the south lawn of the White House. We're going to take you back there as soon as the president's event begins. There are major implications